Top 10 Biggest Scam of 21st Century. Number 10. Satyam. This global IT firm, based in India, falsely boosted earnings by $1.5 billion by falsifying revenue, margins, and cash balances. Founder and chairman Ramlingar Raju admitted the fraud in a letter to the company's board of directors. He and his brother were charged with breach of trust, conspiracy, cheating and falsification of records. Both were released when the Central Bureau of Investigation failed to file charges on time. Number 9. Bernie Madoff. Madoff's Wall Street investment securities firm bilked investors out of $64.8 billion in the largest Ponzi scheme ever. Instead of paying returns to investors out of profits, they were paid with their own money or that of other investors, facing $7 billion in redemption. Number 8. Lehman Brothers. On Monday, September 15, 2008, at 1:45 a.m., Lehman Brothers Holdings Incorporated filed a bankruptcy petition in the United States Bankruptcy Court for the Southern District of New York. It was the largest bankruptcy proceeding in U.S. history. The 164-year-old firm was the fourth largest U.S. investment bank, and its bankruptcy kicked off a global financial crisis. It had invested heavily in high-risk real estate and subprime mortgages. When these markets turned south, Lehman couldn't raise enough cash to stay in business. Number 7. American International Group AIG. This multinational company allegedly perpetrated an accounting fraud totaling $3.9 billion, along with bid rigging and stock price manipulation. It settled with the SEC twice for a combined $1.74 billion, along with several pension funds. CEO Hank Greenberg was fired but faced no criminal charges. Greenberg allegedly booked loans as revenue, steered clients to insurers with whom AIG had payoff agreements and told traders to inflate stock prices. Number 6. Freddie Mac. This federally backed mortgage giant misstated $5 billion in earnings, according to a SEC report issued in 2003. The organization paid $125 million in fines and fired its CEO, CFO, and COO. Under the terms of the settlement, Freddie Mac's board was required to review and revise its bylaws and the frequency of its meetings, along with the company's codes of conduct. The board also was required to determine whether to impose limits on the terms of its members. Freddie Mac, in turn, was required to report on its internal controls and on plans for strengthening its internal audit function. Also, it was required to separate the jobs of chief executive and chairman. Number 5. HealthSouth. This healthcare company allegedly inflated its earnings by $1.4 billion to meet stockholder expectations. CEO Richard Scrushy was accused of asking staff to make up numbers and transactions from 1996 through 2003. Cash and asset accounts were falsified and pre-tax income was inflated. The SEC became suspicious when Scrushy sold $75 million worth of stock the day before the company posted a huge loss. Number 4. Tyco. This New Jersey-based, blue-chip Swiss security systems company was targeted by the SEC in 2002 for questionable accounting practices that inflated company income by $500 million and netted the CEO and CFO $150 million. The money was siphoned through unapproved loans and fraudulent stock sales, disguised as executive bonuses and benefits. CEO L. Dennis Kozlowski and CFO Mark Swartz were sentenced to 8 and 25 years in prison. The company had to pay $2.92 billion to investors as the result of a class action suit. Number 3. Enron. The Houston-based commodities, energy, and service corporation kept huge debts off the balance sheets. Shareholders lost $74 billion, thousands of employees lost their retirement accounts, many employees lost their jobs and the firm filed Chapter 11 bankruptcy. Sharon Watkins, a senior executive, blew the whistle when high stock prices fueled suspicion of wrongdoing. Auditing firm Arthur Andersen was found to be involved. CEO Jeff Skilling was sentenced to 24 years in prison. Former CEO Kenneth Lay passed away before serving time. Former CFO Andrew Fastow, who pleaded guilty to 2 counts of conspiracy, served jail time and forfeited $24 million. Number 2. Waste Management. This Houston-based, publicly traded company allegedly reported a whopping $1.7 billion in false earnings, falsely increasing the depreciation length for their property, plant and equipment on the balance sheets. Charged in 2002 by the Securities Exchange Commission, SEC, the fraud allegedly had been going on for more than 5 years. Resolving the issue by settling a shareholder class action suit for $457 million, the company's new CEO, whose team had caught the discrepancy, instituted an anonymous hotline where employees could report dishonest behavior. According to the SEC, chief executives were the ones perpetrating this fraud. Number 1. WorldCom. The telecommunications company now known as MCI inflated assets by as much as $11 billion, leading to 30,000 lost jobs and $180 billion in losses for investors. The company's internal audit department uncovered $3.8 billion in fraud. CEO Bernie Ebbers was identified as the main perpetrator, underreporting line costs by capitalizing rather than expensing, and inflating revenues with fake accounting entries. He was sentenced to 25 years for fraud, conspiracy and filing false documents. The CFO was fired, the controller resigned and the company filed for bankruptcy.